If you don't know who Robert Kiyosaki is, he's a successful American businessman, investor, and an author. He has written 26 books so far, including the international bestseller Rich Dad, Poor Dad. It was so popular, it has been translated into 51 languages and has sold over 41 million copies worldwide. In this video, we will explore the 6 basic rules for investing that Robert Kiyosaki follows throughout his life. These rules have led him to be a successful investor and businessman. But before we get into it, be sure to subscribe and leave a comment below so that we can share our thoughts with one another. The first step when investing, according to Robert Kiyosaki, is to use other people's money. Robert Kiyosaki is advocating the use of debt to invest. He doesn't mean buying stocks or crypto with your credit card. Rather, he's talking about using what we call good debt. This is taking a liability that is a debt and using it to buy an asset. Taking a negative figure from your liabilities column and moving it into your assets column. This is something which Robert Kiyosaki teaches in all of his content and the premise of his Rich Dad, Poor Dad book. I would recommend that you read this book. It's good for you. Robert advocates that people should take any assets that they have and generate income from them. Then take any liabilities they might have and make them expenses for tax efficiency as the path to becoming wealthy. This is a strategy that many of the wealthiest real estate investors use. Donald Trump and Grant Cardone are both real estate investors who use OPM or other people's money to finance real estate deals. Investors often use strategies to minimize their risk and maximize their gains. If you use other people's money to help fund debt and then deduct it against your tax bill, you will pay less tax. And this is something we want, right? To pay less tax. The second step is to know about the 3 types of income. If a wealth disparity is the reason why some people pay less taxes, then it is because of the 3 different kinds of income. One of the first types of income is earned income. This is the money you earn from your job, where you're exchanging your time for dollars. The second type of income is portfolio income. It helps you to generate more streams of income by investing in various assets and reaping gains when they're sold at a higher price than you bought them for. You get $20,000 from selling shares that cost $10,000, or you could buy a house for $150,000 and then sell it for $200,000. The third type of income is called passive income, and this is where the rich earn their money from. I'm sure you've heard about it before, and this is the form of income that most people dream of. They can sit on a beach and still make money, which makes it the holy grail. Essentially, you're still earning money even if you choose not to work. This is also called cash flow, and this should be the type of income you aim for to get rich, as this is the form of income that bypasses taxes legally. When passive income is achieved by using other people's money, it means paying the least amount of tax and operating inside a business, which leads to investing in assets that generate cash flow, which is the key to creating wealth. Operating within a business will make you tax efficient and allow you to keep more of what you earn. A regular job, on the other hand, means that half of your earnings go to the taxes each year. The third step is to get a financial education. Robert Kiyosaki advocates for financial education and warns people to educate themselves financially. The schools can't cover this, so it's up to you to take the initiative. By educating yourself, you'll be aware of what's happening in your life and know what decisions are best for you. Schools traditionally teach you to get a job and conform to society, but there are fewer jobs out there. Workers are being replaced by robots and artificial intelligence. Taxes are going up and inflation is rising. Utility bills are coming up and it looks like they're not going to stop anytime soon. That's just the reality for people on earned income. People who have a job, they're actually getting poorer each and every day. You may not have known this, but the word job actually stands for just over broke. The government wants to keep you at just over broke so that you continue paying them high taxes and stay on the treadmill of working for earned income and then paying taxes. Is this how you want to live your life? Or do you want to be financially free? Would you like to be concerned about the everyday things like household bills, inflation, and rising costs? Or would you rather not have to worry about all of these things anymore? The rich use leverage, that is good debt, to become even more wealthy. If you don't have a financial education, you may struggle with the debt that the government is getting people into. You might also be crushed by your own personal debt. It's your responsibility to get financially educated, so why not do it in the most enjoyable way possible? It's as easy as reading books and watching videos on YouTube by your favorite investors, business people, and more. The fourth step Robert Kiyosaki advocates is invest for cash flow. Many people want a high-paying job with a nice house and a nice car. However, this is why most Americans are broke. They're focusing on earning money the wrong way. People spend most of their time on the job trying to get a higher salary, working hard to get that bonus, and struggling for it by doing overtime. At the end of the year or when they go to pick up their paycheck, a lot of it has already been taken by taxes. You need to use a diversified approach when it comes to assets and think about more than just earnings on your job. Remember what the job stands for? That's right, just over broke. To becoming wealthy and live the life that you want, you need to invest in assets which bring you cash flow, like real estate, for example. This will provide a source of stable income for you. Instead of focusing on your income, try to acquire assets that will provide you with an income in the future. Then you'll never have to work again. Every minute of every day, your assets produce an income for you. The more assets you have, the larger your monthly earnings are, and the more money that's flowing in. This is why rich people keep getting richer and why the poor stay poor. If you have enough assets to generate enough income for your basic expenses, then you are truly financially free. And this is the goal for many people. True financial freedom is when the money you make from your assets or income streams covers all of your bills. To earn this, you need to change the way you think about money from work to getting cash from your financial investments. This is the secret to freedom. You might not learn about this in school, but don't worry. We'll teach you everything you need to know here. The fifth step is to know that investing isn't risky. When you look into the mirror, know that it's up to you to take on the risks, not the investment itself. A lot of what the stock market trades on is sentiment and human emotion. But if it was all computerized, then the real value of a company would be what its actual worth is, rather than how it's currently being valued by traders. You wouldn't have stocks that are overpriced or underpriced, because the companies would be researched against the real numbers and the true value of the company would be derived from that analytical information. The stock market is a volatile place, and many opportunities exist for those who do their research. However, there are significant risks associated with investing in the stock market because people buy and sell shares without understanding them enough. Understanding the difference between overvalued and undervalued stocks is a valuable skill that all investors should know. When you do your research and perform your due diligence, you can find these two types of stocks easily. But humans are prone to laziness and they just want a quick buck, so they follow the crowd, going to popular shares that their friends or social media people are talking about. They create an artificial bubble which breaks the share in the sector or in that single company. So you can see that it is not the actual investments which are risky. It's the person who is investing in them and how they react to market conditions and their tolerance to risk. In the short term, the stock market goes up and down in waves, and you need to accept this. If you're looking to invest for the long haul, which you should be, stock market history has shown that over a long period of time on average, it returns about 8 to 10% annually. Over the long run, the market is always going up. There are gonna be some fluctuations here and there, but the markets have been on an upward trend, so think long term, not short term. The sixth step is to learn to evaluate risk and reward. As you deepen your understanding of the markets and put investments of your own on the line, you must be able to assess the risks and rewards of each plan. In the book Rich Dad, Poor Dad by Robert Kiyosaki, he uses the example of a nephew trying to build a burger stand business. If you were to give your nephew $25,000 to start a burger stand business, should it be considered a good investment overall? The answer is no. There's far too much risk and not enough in reward for that sum of money. But what if I told you that this nephew of yours had been working for a major burger chain for the past 15 years? And he had been the vice president of every important aspect of the business. He's finally ready to branch out on his own and build a worldwide burger chain. And what if you could buy 5% of that company for just $25,000? Would you be interested in making this small investment if there was the same amount of risk? The answer should be a yes. because there is more potential reward for a similar amount of risk. So you can see that it is important to evaluate risk and reward if you're going to start going after real wealth. Remember what we talked about today in order to become financially secure. Investing is a complicated subject which takes time and financial education to master. However, watching videos like this can be part of your financial education, so give yourself some credit. Thank you so much for continuing to watch my videos. And if you haven't already done so, be sure to subscribe and share this video with a friend who enjoys financial markets. I'll see you in the next one.